Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer. It's almost 23,300 on the Nifty as the benchmark indices gain close to about 0.3%. The bulls have seized control of the mid-cap index. The mid-cap index outperforms with a gain of 1.3%. And the mid-cap index has been rising for the last 3 trading sessions. And in that, they've pretty much erased Monday's manic loss of 2,000 points. On Monday, we fell nearly 2,000 points, and that has been covered up in the last 3 trading sessions. Lots of factors aiding the bullish momentum, the Wall Street rally, the easing of the dollar index to levels of 109, the ceasefire in Gaza Strip, and then all eyes will be on Reliance, Infy, and Axis. So it's a big earnings day for us.
Absolutely right. Good morning, Reema. Like you mentioned, rally aided by the global cues. The Nifty Bank Index is one that's comfortably outpacing the benchmark Nifty Index today, and that's something that's actually giving quite a lot of leg up as far as the entire BFSI space is concerned. You spoke about the mid-cap, small-cap index. Let's look at some of the individual names today that are doing quite well. Look at the life insurance pack. A good set of numbers coming from HDFC Life. The VNB margin was a beat to estimates. The entire pack, so HDFC Life, SBI, Maxfin, ICICI Prudential, all of them doing quite well in the session. Another interesting stock, one that we've been discussing, over this particular week itself, is Kalyan Jewellers. Remember, today the stock entered into the F&O band, but this fall over there has still extended. Today the stock is down another 5%. So concerns linger as far as Kalyan Jewellers is concerned. And the only set of stocks that are seeing a bit of profit booking today is the entire FMCG pack. In fact, quite a bit of a sell-off. Some of the names are down to 2.5%. Names like Colgate, Palmolive, HUL, Tata Consumer, these are some of the stocks that are seeing some profit booking in today's trading session. Even
Devyani International, so some of the QSRs too are correcting after yesterday's move. But let's talk about life insurance, and in particular HDFC Life, because those earnings have fired up the entire sector. Yash is here with the earnings fine print for HDFC Life. Yash?
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates. In terms of specific numbers, for new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3569 crore rupees. Retail AP again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Thank you very much for that. Now let's get to L&T Technology Services, because that's another big mover, 8% higher. Let me tell you 5 reasons what's excited the street. 1, the FY25 organic revenue growth. So, here's the picture. In terms of the guidance, the earlier guidance was 8 to 10%. Now the company is saying organic growth will be 8%, including the acquisition, we'll get to 10%. So some people on the street believe that, well, the organic revenue growth guidance has been tempered a bit, because earlier it was 8 to 10%. Now it's going to be at the lower end of 8%. But here, what I would like to say is that analysts, most of the people on the street expected the company to do that. In fact, there was a Kotak estimate which said 7 to 8%, because after the H1 performance, it just looked difficult for the company to achieve the top half of the guidance, the top end end of the guidance. So that, therefore, is not a negative. Secondly, the stock has underperformed. Taking into account today's up move, it's still down 13% from its all-time high levels. And therefore, the valuations now, according to say Motilal Oswal, are fairly attractive. The stock is trading at about 28 times forward multiple. Q4 numbers, in the Q3 numbers, the company reported the largest ever deal wins. In the first half of the year, the deal wins were subdued. And even going ahead, the company spoke about a broad-based growth, which means all the verticals, whether it's tech, sustainability, mobility, all of them will show good growth in Q4 and FY26. They even spoke about FY26 being better than FY25. And the fifth reason is this is a company which has less exposure to automotive. So see, KPIT Tech has 100% exposure to automotive. Tata Elxsi has about a 50%. This company's exposure is 30 to 33%, and automotive, particularly in Europe, is slowing down. So therefore, in a way, it's less at risk from the slowdown there. And even their mobility segment, I've written it as automotive, but it's actually mobility. But that also has railway, aerospace, off-highway trucks, which is doing quite well. The management commentary also, as we said, was positive. The company spoke about the pipeline being better quarter on quarter and on a year-on-year basis. The demand environment is today is better than what it was a year ago. FY26 to be better than FY25. Q4 margin should be at similar levels to Q3. Comfortable to say all the three segments will grow, and they're maintaining their medium-term aspiration of hitting $2 billion of revenues and margins of 17 to 18%. In fact, we did chat with Amit Chadha, Managing Director and CEO of the company. He's also the NASSCOM Executive Council member. Listen to what he had to say.
Our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year, or 16.2 that we've got. And I do see quarter 4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
Well, a very interesting conversation that you had with L&T Tech, and the stock, like Rima mentioned, doing very, very well. Well, let's now dive into the growth code. We have Abhishek standing by. Abhishek will take us through the Paytm note that MK has written today. Abhishek, what are the key highlights of that particular development?
Well, MK has upgraded Paytm to buy from at. They have increased the target price to about 1,050 per share from 750 that they had earlier. They say that the recent NPCI approval in October 24 has released a major regulatory overhang on the company. So this should help the MTU base get built up again over the next 12 to 18 months. The cross-sell retail financial products like home loans, insurance and wealth products, that will help in improving the revenue per customer or per user for them. So Paytm may be on early path to profitability by FY26, post which profits will keep on increasing as per their estimate. They also say that Paytm's cash to market cap ratio is at 21% when compared to 5% for Zomato. Now this provides strong margin of safety for investors. So additionally, a further easing of regulatory stance via potential approval for payment aggregator license, that could be another positive catalyst as per MK for Paytm. Back to you.
Thank you very much for that. That's a big move on Paytm, 6% higher. Now let's dive into the growth code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, Nigel interviewed Praful Kulkarni, founder of Alpha Leo Capital, to understand why traders must learn to avoid the noise in the market.
Any practical tips for the traders? How can they stick to their strategy and avoid overreacting to news?
News, I think it's a very important question, because most of the people overestimate their ability to judge the exact outcome of the markets to the news. Two things here. One, we need to understand that we don't have the capability to exactly judge what would be the possible outcome or how would exactly market react to the news. And the second thing is, you need to understand that we are at the bottommost layer of the information chain. By the time you get the news, understand that the game is already over, you're late to the party. And at the same time, since you don't have the capability to take such big bets and sit through the ups and downs, and you don't have the capability to exactly judge how the market's going to react, I would say retail traders are better off not looking at the news, and they would just have to stick to their strategy by completely eliminating the noise.
Welcome back to Trading Hour. Well, Axis Bank is in focus ahead of its Q3 earnings today. Abhishek joins us with more details.
Well, it's expected to be a weak quarter for Axis Bank. Our poll suggests the NII growth on a YOY basis may be one of the lowest that you are seeing in last 13 quarters. Now, deposit and advances growth will be seen closely. Now, Citi estimates deposit growth of 11% YOY and 3% quarter-on-quarter, which is higher than the industry average, while they estimate, advances growth of 10% YOY and 2% quarter-on-quarter, which is lower than the industry average that we had as per RBI data at the end of December 24. So, net interest margin may decline both YOY and quarter-on-quarter. Kotak Securities estimates 11 basis point decline in net interest margin YOY and about 4 basis point on a sequential basis. Slippage is expected to rise quarter-on-quarter. Again, Kotak Securities estimates a slippage of 5,000 crore versus 4,400 crore in the previous quarter. So asset quality expected to deteriorate. Citi estimates gross NPA ratio to increase by 20 basis point quarter-on-quarter and net NPA ratio to increase by 10 basis point on a sequential basis. Provisions can remain elevated, thereby impacting the earnings momentum. Again, Kotak Securities estimates 198% gain with respect to provisions rising on a year-on-year basis and 5% increase on a sequential basis. Near-term, loan growth outlook and deposit growth outlook will be seen closely. Deposit is becoming a challenge for the sector. Our poll suggests NII growth of 9% YOY and about 1.5% sequentially. We are working with a profit growth of 3.5% YOY and a decline of more than 9% quarter-on-quarter. Back to you.
Thank you very much for that. It's a big earnings day. All eyes will also be on Infosys. Those numbers typically come out by 4:15, 4:30. Now, we're expecting a revenue growth which is about flat in dollar terms, but in constant currency terms, it should be a growth closer to 1%. Margins likely to expand 20 basis points to 21.3% and a marginal 4% jump in the company's profitability. But these are the numbers. All eyes will be on the guidance. Now, the current guidance stands at 3.75 to 4.5%. The big question is, does the company revise the upper end of the guidance? The upper end stands at 4.5%. Can they push it up to 5.5%? Margin guidance is likely to be maintained at 20 to 22%. What will the street watch? Well, recovery in discretionary demand, because so far all the IT companies, whether it's TCS, we even heard L&T Technology, they're all talking about discretionary demand being better, the situation being better than it was 3 months ago. Also for Infosys, wage hike, timing and the implications, the FY26 outlook and commentary on important verticals like BFSI, retail, high-tech will be tracked very closely.
Thank you so much, Rima. Another busy day as far as IT earnings are concerned.
We've got LTIMindtree also, not to forget.
Well, let's now slip into a short break. When we return, we'll discuss market technicals with Vishal Malkan and also discuss his top trading bets.
Welcome back. All eyes will also be on Reliance Industries as it reports its numbers. Well, first, let's get you through the key expectations. The revenue growth is likely to be flat on a quarter-on-quarter basis. But the key that the street is going to be watching will be the margin performance. Margins are likely to go up for the company. The absolute EBITDA is seen up 8% and margins at 18.4%. And this will drive a jump in the company's profitability. Now, what's going to drive the company's margin performance this time around? Well, first, the oil to chemical business, which has been subdued so far, is likely to recover. Secondly, this would be the second consecutive quarter of a strong performance for the telecom business and retail, where there is a continuation of the festive demand. But those gains, all these gains, will be offset by some pressure that we are seeing in the upstream side of the business. where the production is likely to decline, particularly on oil to chemicals, the refining margins. That's a number we track very closely, and that, according to some estimates, is likely to rebound to $7.6 per barrel versus $5.6 per barrel, not billion, and this is on account of the recovery in the Singapore GRMs. For the telecom companies, there was a tariff hike which they undertook in July. And usually, whenever there is a tariff hike, it takes about 2 to 3 quarters for the full pass-through to take place. So for the telecom business, even Q2 was strong. We had about, a 7 to 8% revenue growth. The ARPUs went up 7 to 8%. And this would be the second consecutive quarter, which will benefit on account of that. So a top line growth of about, 4 to 5%. Margins are likely to inch up even further, expanding 100 basis points. So that's going to be driving the telecom business. The street is increasingly turning optimistic on Reliance Jio after underperforming last year. Last year, in 2024, was the first year in 9 years that Reliance Industries gave you a negative return. But now analysts are pointing out that valuations are attractive. There are triggers like a potential Reliance Jio IPO. So that's one. But even in terms of the pure business, the refining business, the oil to chemical business could recover. Telecom could have a stable year. Retail, they're hopeful things will recover because the base is low. Even if the consumption doesn't pick up, but just purely in terms of the base effect, you could see maybe a double-digit growth. So even fundamentally, analysts are now turning positive. And if the Jio IPO happens, then that's the additional
significant value unlocking trigger is what the street will look forward to. Reliance Retail, Reliance Jio, value unlocking triggers could lay ahead. Well, moving on, Vishal Malkan from malkansview.com joins us for a quick technical check on the market. Thank you so much, Vishal, for joining us. There's been a bit of a strong bounce back as far as markets are concerned. Do you think this particular bounce can sustain? And what are your view on Nifty as well as Bank Nifty?
Yes, I think we are in that time zone when typically market makes an important move in this second, third week of January, which we have seen in the last so many years. And Nifty finding its feet around 23,300, 200, testing those bottoms couple of times in the last couple of months with some bullish patterns, and especially today with some volumes. So I think this bounce can sustain, and we can look at targets of 23,600, 700 in the next few trading sessions. And going forward, it can be higher also. My stock picks for today would be, the first one would be India Cement, which I think has made a very strong consolidation at this 375 levels. So I'll go with a buy on that with a stop of 370 for targets of 385 and 395. And the second one would be Hoodco, which is also making good support and patterns on daily as well as weekly chart with a stop loss of 218 for targets of 235 and 245 in the next few trading sessions.
Thank you very much for that. By the way, Hindalco and Nalco are pushing higher, and there are reports that China has capped the aluminium production, and therefore prices, may go up. And that's the reports which are doing the round for the last 1 hour, and we've seen the stocks of Nalco and Hindalco inch up.
Even Vedanta for that matter, that's up almost 3.5% as well. Well, we'll now take a quick break. Up next, we'll discuss market fundamentals with Sahil Kapoor from DSP Mutual Fund. Welcome back to Trading Hour. Well, Reliance Retail 2 is expected to report its Q3 results today. Mangalam joins in with what the street is expecting from this particular vertical from Reliance Industries.
For the third quarter for Reliance's retail business, because of muted consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially, growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, quarter 4, quarter 1 and quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins, and we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year-on-year growth in the EBITDA and 8 to 9% growth quarter-on-quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll, which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Yusta and Swadesh, and finally their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
Thank you very much for that. Need to get into a break, but as we do that, here is some good news for all our viewers because India's business news leader is now just a click away. We're introducing the CNBC TV18's all-new app. You can get instant access to breaking news, all our in-depth articles, financial world updates at your fingertips. So don't wait. Download the CNBC TV18 app from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Story that you would like to tell?
No, right now my laser focus is on my next film and preparing for it. And the new story I want to tell is Irish cricket, Scottish cricket, and cricket from the Netherlands. It's exciting me. It's something new, It's like this new toy I've got my hands on. I'm really looking forward to it. I can't wait to start working on it. I've never been the kind of person who's very good at just going and waving my hand. I'm somebody who likes to get down on all fours and get dirty and really work.
Be in the trenches.
Oh, I love that.
Welcome back. Let's get you a CNBC Awaaz exclusive. Now, sources say the cabinet may soon approve an increase in ethanol prices. It's an important story. Lakshman Roy of CNBC Awaaz is now with us with the details. Lakshman.
देखिए, जो मुझे सूत्रों से जानकारी मिली है उसके मुताबिक सरकार एथेनॉल को बढ़ावा देने के लिए जल्द ही एथेनॉल की कीमत बढ़ाने के प्रस्ताव को मंजूरी दे सकती है और ये प्रस्ताव बहुत जल्द कैबिनेट में लाया जाएगा और कैबिनेट से इसे मंजूरी मिलने की संभावना है। जो प्रस्ताव है उसके मुताबिक एथेनॉल की 3 अलग अलग कैटेगरी होती है। इसमें बी हैवी मोलासेस, जो एथेनॉल हैवी मोलासेस होते हैं जिससे एथेनॉल बनता है, उस बी हैवी मोलासेस की कीमत में ₹1.82 प्रति लीटर की बढ़ोतरी की जा सकती है और अभी इसकी कीमत ₹60.73 उसे बढ़ा करके ₹62.55 की जा सकती है। बी हैवी मोलासेस वो होता है जब गन्ने से चीनी निकाल लिया जाता है तब भी कुछ गन्ना में चीनी बची रह जाती है तो उसको बी हैवी मोलासेस कहते हैं। इसके अलावा जो केन जूस है उससे जो एथेनॉल बनेगा उस केन जूस में की कीमत में ₹1.31 की बढ़ोतरी संभव है। अभी फिलहाल ये ₹65.61 प्रति लीटर है, उसे बढ़ा करके ₹66.92 प्रति लीटर किया जा सकता है। उसका सी हैवी मोलासेस होता है जिसकी कीमत अभी ₹56.28 प्रति लीटर है, उसे बढ़ा करके ₹63.15 प्रति लीटर की जा सकता है, यानी करीब ₹6.87 के आसपास बढ़ोतरी की जा सकती है। ये जो बढ़ोतरी होती है वो चीनी कंपनियां जो एथेनॉल ऑयल मार्केटिंग कंपनियों को बेचती हैं उनके लिए होती है। ऑयल मार्केटिंग कंपनियों को इस कीमत पर ये सारी एथेनॉल खरीदना होगा जिसको पेट्रोल में ब्लेंड कर सके। तो ये कह सकते हैं कि एथेनॉल बनाने वाली कंपनियों के लिए ये एक अच्छी खबर होती है। कई कंपनियां, चीनी कंपनियां नहीं भी होती है लेकिन एथेनॉल बनाती है, वो अगर ऑयल मार्केटिंग कंपनियों को बेचने जाएंगी तो उनको ये कीमत मिलेगा। कीमत बढ़ाने का मकसद ये है कि एथेनॉल के उत्पादन को बढ़ावा दिया जाए।
Well, a very important story coming in from our colleague at CNBC, Lakshman, telling us that there could be a hike as far as B-heavy molasses prices are concerned. But moving on, Sahil Kapoor, market strategist at DSP Mutual Fund, joins now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Sahil. First up, you've come out with a very interesting report where you've actually said that equity returns have, apart from a few countries, have actually lagged even US bond market returns. So first up, going into 2025, given the kind of outperformance that we've seen in equity markets over the last couple of years, how are you positioning yourself and what is your view as far as equities are concerned?
So if it is about 2025, I think it's very hard to say how the year will go. The only data that we have, or at least we had just a few months ago, was that equities were not priced cheap. When you look at equities as a whole, when you look at Indian equities, if you take, let's say, NSE 500 as a basket, it was trading at about 28 times trailing earnings, price to book of more than 3.7 times. These are not cheap numbers. Earnings growth, which was by the end of March 24, averaging about 22% CAGR over the last 4 years, is now on a YOY basis struggling at about 7-8%. So when you look at the aggregate ROE number, it's about 15%. So anything which has an ROE of 15% but grows at 7-8% is going to be very hard to justify a multiple of 28 times. So I think from a, let's say, next few quarters perspective, it makes sense to be conservative. Maybe 25, 26, unless you see cheaper equity prices, it's very important to look for value, look for margin of safety, and possibly exercise conservatism.
Sahil, I was quite interested to read about the 7 market myths that you've debunked in one of your reports, which goes on to say that if GDP rises, which means if India's economy is growing, we're going to get to Viksit Bharat, then there is no other way but for the markets to move up, and many others. So take us through the 7 myths and what is the reality?
So maybe we'll pinpoint a few which are very important. Yeah. First is that I think there is a lot of narrative fallacy and a thought that if GDP is going to go from X to Y, market cap should replicate that. And just to put 2 facts into these numbers, first is that when you look around globally, you will find that in most instances, it's not the case. There are countries where GDP has multiplied by a factor of 10, but equity markets have delivered returns which are negative. Case in point is our neighborhood, China. And there are many other. I mean, you could take a look at, let's say, Malaysia, Indonesia. For that matter, look at many European countries, you'll find very similar numbers play out. The only thing is that when you go back in time and look at data, you look at the US market and you look at the Indian market. Both of these markets have performed fabulously well. What it does is it creates what I call the problem of induction. You look at the last 25, 30 years for India, you look at the last 150 years for US, and you end up thinking that equity markets will always give you fabulous returns, which is true for these 2 countries. But unfortunately, it's not the case in many other countries. And therefore, if data falsifies that even if there is one country where GDP growth has not translated to equity returns, I think it is enough to burst this myth that GDP is equal to equity returns or GDP growth. Second thing is that, then what is more important, and which I published the second myth, that what is more important in terms of equity returns, or you could say, why has India outperformed if it is not about GDP or policy making, etc. So one very important factor is what is the return for shareholders? And there comes a very important distinction. When you look at the US market, almost 39 to 40% of companies in US from S&P 500 have delivered ROEs of more than 20%. So this means that there is a large shareholder return being delivered to shareholders in the United States. And the second country, which is India, 1/3 of companies in India have delivered a ROE of more than 20%. Now, this is a great outcome, and we think that this is one of the most important reasons why India has delivered for a very long period of time. And I would choose managerial and entrepreneurial sagacity, their ability to navigate cycles over any other narrative of, let's say, GDP growth or any other number. So the crux of the matter is that managers and promoters in India have been able to deliver shareholder returns. And that is the reason why India has outperformed for a very long period of time, not only because there is a growing construct. And for that matter, we've shown in data that a country like Brazil, where the last 30-year GDP CAGR is only 2.5%, has actually delivered one of the highest dollar returns globally. So this is again a very, very important parameter to look at when you think about long-term equity performance. It's not only about how GDP is going to pan out. Another myth that in the overall scheme of things we've highlighted is a lot of people believe that very simple investing structures like a systematic investment plan or a dollar cost averaging is only for the retail investor. And it is not something that a sophisticated investor should exercise. And we've shown that even in countries like Japan, where 30-year returns are more or less negative, inflation-adjusted returns are negative, a simple SIP or dollar cost averaging strategy also delivers 5 to 6% CAGR dollar returns, which are fabulous. You will not get these kind of returns very easily. So once again, there is a myth in the market that simplicity is too simple. So we believe that simple structures are much better than creating any complex structures over time. So these are some of the myths that we've spoken about in our report, and of course there are a number of other myths that we bust.
Right. Sahil, another very interesting point you've made is actually on gold being a poor investment. So that's another myth that you've written about. So talk to us about number one, gold. Number two, if you have a view on real estate, whether that should be looked as an investment vehicle. And you've also spoken quite in depth about quality businesses being stable. So these 3 points, if you could give your quick view on.
So gold is a very interesting case. I think in India, there is a big affinity for gold and people have done quite well over the longer term. One case in point I wanted to make, we've shown that in our report also. When you look at gold as an investment and look at all emerging markets, you will see that except in India, in every other single emerging market, gold has outperformed equities in the 21st century, which is the last 25 years. Even when you look at developed markets, in number of developed markets, I think almost all of them, gold has outperformed equity. Even in United States, in dollar terms, gold has outperformed equity. You could argue with the starting point and take a different position. If you take data from, let's say, another 30 years ago, you will find different numbers. But the case in point is gold outperforms equity in emerging markets. And the reason is that emerging markets go through a lot of accidents. There are political turmoils, there are wars, there is inflation, and all of these result in currency depreciation. And gold helps in countering that by a very wide margin. Even in India, just about 3 to 4 years ago, gold was ahead of equities over a longer term CAGR. So even in India, it's not a completely equity win. They lead and lag over a certain period of time. So that is one of the most important reasons to have gold in the mix in your portfolio. It provides possibly sort of a disaster hedge, which is very, very important for equity investors, specifically in emerging markets. And I think in the last 2 to 3 months, we saw some amount of this play out when currency depreciated. You saw that precious metal had a good time. Second point that you mentioned is about quality businesses. And I think there is a sort of a myth that if you buy a great business and hold it for a very long period of time, you are sorted. But the data also tells you that even great companies, which are fabulous businesses, can go through massive stock price correction. And we've showcased that in the report. A lot of great companies, which have compounded very well over a longer period of time, have fallen between 50 to 90%, even during their best times. So stock prices are slaves to sentiment, and businesses can continue to do well. Eventually, investors will do well, but you should have the stomach to, digest that volatility.
Right. Thank you so much, Sahil, for joining us and, running short on time, but we have a lot more questions for you. But moving on, one stock in focus is Aeroflex Industries. The stock is surging after reporting its Q3 earnings. Vamakshi is here with the earnings fine print.
Well, Vivek, a good set of numbers coming in from Aeroflex. The company's revenue saw an uptick of almost 36%, coming in at almost 100 odd crores. The revenue growth that we saw this time around was much stronger compared to what we've seen in the recent quarters. So therefore bodes well for the company. The gross profit margin for the company also saw a substantial improvement of nearly 220 basis points to 39.9%. The EBITDA margin resultantly also saw an expansion of nearly 285 basis points, coming in at 21.7%, which is the highest that we've seen since Q4 of FY23. The net profit for the company came in at 15.2 crores. This is an uptick of almost 68% year on year, and in fact with that the net profit is at a multi-quarter high for the company, so bodes well. When we look at some of the key internals for the company, strong growth was seen in their assemblies business, which is their value-added products. They saw an uptick of almost 101%, so good growth coming out here as well. The export sales, which account for nearly 77% 7% of the company's mix, saw an uptick of almost 10.5%, but it is the domestic business that actually drove growth this time around, because the domestic business is seeing a surge of almost 183.6% this time around. The company also announced additional capex plans in addition to what they already commercialized in December 2024. They've announced that SS hose and braiding capacity will be increasing from 16.5 million meters per annum to 20 million meters per annum. For miniature metal bellows, which is expected to be a new product for them, they will be installing a capacity of 2.4 lakh pieces per annum, and combined capex for both of these will stand at 77 crores, which will largely be funded through internal accruals. So good set of numbers coming in. The company has announced expansion plans, and resultantly the stock is surging in trade today.
Thank you very much for that. Now from reviews to preview, let's talk about LTIMindtree. It used to be a part of the Nifty, now it no longer is, but numbers will be important. This is a stock which has underperformed the markets. So last year, LTIMindtree was down 34% as growth for the company slowed down. So the key is, does growth come back? In the current quarter, we're expecting about a 1.5% kind of constant currency revenue growth. In dollar terms, 1.2%. Margins are seen under pressure on account of wage hikes, so margins seen dropping. Profits are down close to about 10%. As I said, the reason for the margin drop is the wage hikes. And the margin decline is a bit of a worry for the analysts. So for one, growth needs to come back. And two, margins for the company need to recover. Look at the way the margins for the company have trended. They've been under pressure. And in this quarter, if it comes at 13.5%, it would be a record low. The company's desired margin range is 17 to 18%. So how do they get to that? That's something the street will watch. But generally, brokerages again are turning bullish on LTIMindtree. One, because of its underperformance. Two, because it has a high component of BFSI and discretionary spends, which is why it got affected by the slowdown. And now as things are recovering, the hope is that LTIMindtree can get back. This was a company which used to grow in the leaders quadrant, right? The top end, those were the words they would use. And then things slowed down for the last 18 months. And now I think there is hope that it gets back to that. But again, the margin performance is going to be tracked very closely because it's come off from what they aspire to.
Thank you so much, Reema. Quite a lot to look forward to as far as LTIMindtree is concerned. We'll take a quick break. We'll get you more on the markets on the other side.
Welcome back. Here's another important story that Sapna is now going to be telling us. She's joining in with the latest on the IDBI Bank divestment. Sapna, take it away. Can you hear us? Okay, we'll get back to Sapna in just moments from now. In the meanwhile, proxy advisory firm IIAS calls on regulators to implement a majority of minority voting mechanism for approving promoter remuneration, citing a steady and significant rise in the compensation paid to promoters. Hetal Dalal, President and COO of IIAS, is now joining in. Hetal, thank you very much for joining in. You have reviewed nearly 900 proposals over the last couple of years. So first, tell us, by how much has the compensation gone up? Why is this such a big issue?
I think the compensation levels, and we've seen this over the years, has outpaced revenue and profitability growth. And therefore, there is a certain delinking of compensation with company performance. And that's a level of concern. In pockets, compensation has been significantly high, upwards of 50 crores, and one or two instances upwards of 100 crores. And therefore, we find that in these in these pockets, there is a significant pushback that we see from investors. But it's the promoters' votes that carry through these resolutions, and therefore because promoters have their voting power, it allows them to get paid at will. I think we also find that nomination and remuneration committees have been diffident in actually setting accountability for the kind of compensation that promoters are getting. And therefore, fundamentally, we believe that there should be some kind of rein-in of promoter compensation. But our ask of saying that the resolution should be put to a majority of minority vote is a fundamental tenet of conflict of interest, right? I own 52% of the equity or 55% of the equity, and I vote on my own compensation. It basically is a fundamental conflict of interest. And therefore, we believe that like related party transactions, this resolution too should be put to a majority of a minority vote.
And what you're saying is that that when the promoter compensation comes up in the AGM, only 10 resolutions were rejected in the last 21 months. But had we followed what you're saying, that a majority of the minority shareholders need to approve it, then 216 resolutions would have been rejected out of nearly 900? Is that the analysis?
Right. Yes, that's right. And this data comes from voting patterns, right? We just look at removing how promoters have voted and then see whether the resolution is passed or not. You will find that the pass percentage drops from 99% to 75%. Essentially, 1% gets defeated, which is 10 resolutions. Another 25% would have actually not passed if it had been a majority of minority vote. And this is for the period of resolutions that we evaluated from 1st of January 2023 to 30th of September 2024. So that's a 21-month period. If you look at the same pattern for 2022, we found that 34% of the resolutions would not have made it to the majority of minority vote. And this was for 2022 data. So the pattern continues. You're seeing this year on year that promoters are voting their compensation. Investors don't like it, but because they have majority vote, they are allowed to pay themselves effectively at will.
Ethel, you've spoken about investor concerns, and two concerns stand out significantly. Number one, you've spoken about a lack of adequacy of disclosures in resolutions as far as promoter pay is concerned. And the second point that you've highlighted is there is actually involvement of promoters themselves as members of the nomination as well as the remuneration committee. So, number one, talk to us about these concerns and how do you expect regulators to go ahead and address these concerns?
Sure. I think when we look at compensation disclosures for, let's say, professionals vis-a-vis promoters, right? In a lot of the compensation disclosures for promoters, there is really no performance metrics which is disclosed. So if the promoter gets paid 1% commission or profits, and it's a flat 1% in several instances, sometimes it can even be up to 5% of profits. The question is for achieving what, right? On the contrary, when you look at compensation for professionals, you will see a reasonably clear articulation of what actually drives variable pay. And therefore, in promoter and compensation for professionals, you see a greater articulation of or alignment of pay versus performance than you would see for promoter compensation. Also, in several instances, we've seen where companies don't perform as well, or they're actually underperforming their peers in the same industry. If commission sort of drops, fixed pay goes up. So the kind of compensation that promoters get still remains the same, independent of company performance. So fundamentally, we believe that the disclosure level should include a full cap on the absolute level of compensation. You can't say 1% of profits. Let's say Reliance Industries says we're going to pay the promoter at least up to 1% of profits. What does that number really mean? Or even Infosys for that matter, right? So size drives a lot of these things. And for companies with a reasonable size, the regulatory thresholds of 1% to 5% really don't add any meaningful constraints. So one is a cap on the absolute level of compensation. Second is what is the accountability for the variable pay? What needs to be achieved? And then companies differ from saying that we don't want to put out targets saying revenue growth of 15% and EBITDA growth of 5%, but at least what are the bases on which the variable pay will be paid out is something that companies need to articulate. Whether these actually have any of these ESG metrics as well, or is just going to be a P&L number which one of the parameters of P&L that will drive the entire compensation. So even for compensation for professionals, one of the things we find lacking in disclosures is the quantum of stock options that will be granted to these professionals over the proposed tenure. So today you are voting on the next 5 years appointment and their compensation, but stock options is a very material element of the compensation structure which doesn't get really disclosed, and it's left to the NRC to decide as and when the company performs and as and when they actually do the grant. And there we find that a significant proportion of the compensation really cannot be estimated. So some of these things need better clarity. From a regulator standpoint, our view is that if you put it to a majority of minority vote, all these issues get ironed out because the quality of disclosure improves dramatically, just as what you're seeing has happened as far as related party transactions are concerned. All the other pieces, and they're likely to face a significant pushback given that corporate India is 2/3 controlled by families. But in the absence of that, at least mandate these kind of disclosures which talk about how does the pay align company performance and what is the kind of final cap that you're looking at. And some of these elements need to be better detailed out or at least provide a framework. if you look at RBI, for example, right, RBI for bank CEOs has a very structured framework where they say that there is fixed pay and variable pay will be up to 300% of fixed pay. And that again gets split between how much will be stock options and how much will be cash pay. So there is a model. Now you can argue that because, bank CEOs are custodians of people's money, we are well brought this in, and you can't do that for all public sector, but you can serve all sort of private sector. But you can certainly bring in a degree of structure which for disclosure that helps investors understand exactly what is the compensation number they are voting upon. I think that's really broadly where we are. I missed your second question. Can you just repeat that?
Hazel, one final question, before we wrap up this particular discussion. Citing a specific case of a company like Reliance Enterprises, the company performance maybe has lagged peers, but if you're looking at the promoter compensation there, it's been quite high, along with stock options also being given. Do you have a view on that particular company? And other than that, any examples you can cite where you feel that there should be more stringent regulation coming in as far as promoter action or promoter compensation is concerned?
See, I think whether promoter compensation or professional compensation, I think one of the things that NRCs need to do is simply disclose how they benchmark the compensation. Once they're compelled to disclose how do they create a peer, and companies have disclosed this well, government companies do disclose this. Once they disclose how the compensation for either the promoter or the professional has been benchmarked vis-a-vis peers, vis-a-vis size of company, vis-a-vis growth or potential growth, I think that brings in a lot more balance in the remuneration structure than simply looking at it at a point in time.
Heather, thank you very much for joining in. It's been a great conversation and quite the eye-opener. So thank you with the data and even the recommendations coming in from IIAS. We leave the markets fairly stable in the last 1 hour. So the Nifty still holding pat at 23,300. The high today was 23,400, roughly there. But that slip happened in the first 1.5 hour of trade. And after that, things have been steady. The mid-cap index again off its high, but still holding on with a gain of a little more than 1%. Banks continue to outperform. It's a wrap on Trading Hour on that note. Thank you for watching. Stay tuned. Halftime Report is up next.